Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at DGXX.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis of DGXX. This is a company sitting, right at that intersection of high-demand data centers and the explosive growth of AI infrastructure.
And we've really pulled apart the reports here. The picture that emerges is one of extreme promise, but also balanced by some extreme risk.
Exactly. We have to start with the momentum because you just can't ignore it.
Not at all. This stock has been on an absolute tear. Year-to-date, DGXX is up, a massive 166%?
And 77.5% over the past year. It's not just beating the market, it's crushing its sector.
Yeah, that kind of high-velocity movement tells you there's some really deep investor interest already baked in.
Right. But what's fascinating is understanding why that interest is so intense. It's not just a speculative rally. It's driven by a core, verifiable competitive advantage.
You're talking about their subsidiary U.S. data centers.
That's the one. They aren't just running generic server space. They operate an AI-ready data center platform. So we're talking specialized cooling, power distribution, all the things that, large language models need.
Then the real kicker, the key that differentiates them from everyone else, was that news from earlier this month.
The Tier 3 certification.
Exactly. For anyone who isn't deep into infrastructure, Tier 3 is, it's crucial. It confirms high reliability infrastructure. We're talking 99.98% uptime, guaranteed.
It's like a 5-star safety rating for a supercomputer facility. If you're a big company running mission-critical AI, you cannot afford downtime.
So that certification moves DGXX out of the crowded mid-tier market and into that exclusive bracket that the biggest AI clients demand.
And that's why the stock popped 8.3% on November 2nd. It immediately validates their pricing power.
And it connects to their bigger picture, right? This strategic focus on next-gen modular data centers and energy expansion. They're building for the future.
That's their long-term distinction. Now, this is where we have to pivot and ask some tough questions.
Right. We've got the tech leadership, we've got the revenue potential, but what's the financial reality behind it all?
Let's start with the top line, which, to be fair, is strong. Q3 2025 revenue hit about $31.17 million.
That's nearly 50% expansion over 5 years. So demand is clearly there. They are gaining market share.
But here's the central tension of this whole story. Why isn't that strong revenue growth leading to profit?
This is the major risk factor. They're growing fast, but they seem to be doing it, incredibly inefficiently.
Yeah, exactly. Profit margins are deeply negative. And these aren't small dips. The gross margin is exceptionally low at just 4.22%.
And the net profit margin?
It's a staggering minus 39.25% over the last 12 months. That signals severe, ongoing operational inefficiency.
It's like they're trying to build a new 5-star hotel every quarter. They're filling the rooms, sure, but the construction and overhead costs are just outweighing the rates.
That is the perfect analogy for a high-burn growth story. However, there are two sides to this liquidity coin.
Okay, so while the cash flow is a bit scary, the balance sheet offers a lifeline.
A vital one. They are debt-free, a 0% debt-to-equity ratio, and they hold about $26.64 million in shareholder equity.
So no creditors breathing down their neck. That gives them a lot of flexibility to weather these high-cost phases.
Assuming investors continue to fund that negative cash flow.
Which we can't just gloss over. Free cash flow is negative, almost minus $9 million. Operating cash flow is minus $8.19 million.
Right. And the current ratio, which measures short-term stability, is 1.2. So their assets slightly exceed their liabilities.
So short-term stability is there, but that negative cash burn is a serious, almost existential risk if it continues.
But what's interesting is the analysts are showing some confidence. H.C. Wainwright recently raised its FY 2025 EPS estimate.
Right, to a slightly less negative 48 cents from 55 cents. It's a small change, but it signals they think operational improvements are starting to work.
Which leads us perfectly into the technical side, because if the financials are volatile, the stock price is even more so.
Yeah, this is a crucial section for anyone thinking about trading this name.
Absolutely. This stock is not for the faint of heart. Its high volatility is confirmed by an average weekly movement of 19%.
And the beta, it's extremely high at 9.72.
Yeah, to put that in perspective, it means if the S&P 500 sneezes and drops 1%, DGXX historically catches a catastrophic flu and drops almost 10%.
So massive risk, but also massive opportunity for tactical trading.
And that volatility is currently riding a very strong current. The stock is trading well above both the 50-day and 200-day moving averages.
Which confirms the underlying uptrend is still intact despite the wild daily swings. The market consensus is still bullish on the story.
So for tactical traders, you need to define the key levels. Resistance is currently fixed at $6.65.
That's the ceiling it keeps hitting.
Right. And strong support, where buyers keep stepping in, is down at $4.74. With the last close at $6, we're right in the middle.
So a confirmed breakout above 665 could really ignite some short-term momentum. That's the immediate target.
And here's where it gets interesting for momentum players.
Yeah.
The technical indicators like RSI and MACD, they remain firmly in bullish territory.
So these gauges are saying the stock isn't really overbought yet.
Exactly. It suggests accumulation's continuing without reaching those extreme levels that might trigger sharp correction. The technicals support the narrative.
Okay, so let's move on to the near-term calendar. What's coming up?
The most immediate scheduled catalyst is the Q4 2025 earnings release. That's expected around December 18th.
And this isn't just a routine call, is it?
No, this is the absolute flashpoint for the market. Investors will be laser-focused on one thing: gross margins.
That's the metric. We need to see real evidence that management has better cost controls in place.
Any sign that the revenue is starting to stick to the bottom line will be hugely positive. Any more deterioration will trigger a sell-off.
And beyond earnings.
We're looking at key institutional events. A major ETF rebalancing on January 2nd, 2026. Because of the momentum, inclusion or exclusion from a big AI ETF could cause huge volume spikes.
And then the institutional shareholder filings in February to see where the smart money is moving.
Right, but that Tier 3 certification we mentioned has really opened the floodgates for speculation.
Market chatter.
A lot of it. There's significant buzz about potential new, large AI client partnerships. Winning even one flagship client could redefine revenue projections overnight.
And we're also hearing unconfirmed rumors about a new AI-driven energy management product line.
Which would be strategically smart, a higher margin, software-based product. And of course, there's always a chatter about an uplisting to Nasdaq U or the NYSE.
So while these are rumors, if any of them are substantiated, it could rapidly boost data center utilization and finally provide the scale they need to overcome those high costs.
That is the primary upside lever right now.
So if we zoom out to the long-term outlook, the macro trends couldn't be better for a company like this.
No, you're talking about the continued, almost exponential expansion of AI, global cloud migration, decentralized energy demand.
All of those structural trends align perfectly with DigiPowerX's platform. They are surfing a generational wave.
And strategically, we need to watch for M&A or alliances, a partnership with, say, a major utility or a larger tech provider could inject some much-needed operational discipline and capital.
And finally, diversification. I think that's key long-term. Maybe expansion into adjacent enterprise AI services or even crypto infrastructure.
That would generate new revenue streams and, just as importantly, mitigate some of that client concentration risk we see in the filings.
So what does this all mean for you, the investor? Ultimately, the story of DigiPowerX is a classic growth versus cost equation, isn't it?
It absolutely is. It's balancing that high-octane growth potential, fueled by cutting-edge AI infrastructure and that crucial certification, against the critical risk of deep negative profitability and cash burn.
The technology is leading the way, but the operational execution is playing catch-up.
And that earnings report in December will be the moment of truth. We need to see if management is finally converting that tech leadership into efficiency.
So the big question for you to mull over is this. Can a company run this hot, burning cash at this rate and sustain its technological edge long enough to become profitable before the market loses patience? That is the billion-dollar balancing act right now.
If you want to keep up with how DigiPowerX handles these challenges and watch for those crucial catalysts, make sure you subscribe to Smart Wealth with Joshua for our next update.